Oh, come on. So remember, we're looking at some major or basic areas of tax, where we said amongst the main concepts that you should always be having anytime you are dealing with tax. We talked about, of course, number one, understanding allowable and unallowable, taxable and taxable. Also, it was important for us to be able to understand, of course, the aspect of taxation of other sources of income, or rather what you normally refer to as investment income. The other part that will also be important for us to understand is the approaches that you normally consider anytime you are to handle the aspect of tax. So this should take us to the approaches of determining our taxable income, and these are what you need to do. Approaches. So looking at approaches of determining our taxable income, our focus will always be on the two approaches. So about approaches used in the determination or simply computation of taxable income. We have two approaches. The first approach is what we normally talk of. The first approach is what you normally refer to as a gross approach, gross profit approach. Number two is what you normally refer to as a reported profit approach, and of course, these are the two main approaches that, if at all you are to say we want to consider our taxable income, then we must always follow this approach. So the most important question that we should always ask ourselves is, when am I supposed to use this approach, and at what point will you be required to use a certain approach? That is what we'll always be talking about mostly. So then we jump straight to the first approach. Let us understand the format of this approach and when are we supposed to use this approach. So this is the first approach, a gross profit approach. Gross profit approach format. Gross profit approach format. So it will be important then for us to be able to understand the whole of this approach and when are we supposed to use the same approach. Yeah. So it should take us to this format. So understanding the gross profit approach, remember, we just be looking at it as if we normally consider any other form of business that is talk about in your financial accounting concept. So these are what we'll always be applying. So number one, in this case, the title of what you're presenting is always very key. Say, for example, in this case, you're saying maybe you're having, say, like Mderasa Limited, computation of taxable income for the year ended 31st. December 2024. So using this format, we will be considering, of course, the whole idea is to check or to come up to the gross profit. The whole idea will be for us to come up to the gross profit. So therefore, in this context, you're going to start with our sales. What will constitute our gross profit? We normally talk about our sales. We less our cost of sales. Cost of sales. We less our cost of sales, so that as at the end of the day, we will be achieving our gross profit. So this will give us our gross profit, and this will be our starting point. So from our gross profit, we are going to consider these elements: the income relating to our business directly, such as discounts received, we talk about it at that point. We can't talk about foreign exchange gain realized. See, you can have this one here. You can talk about maybe insurance compensation for loss of stock only, or of course profit. We have it at that point. We talk about decrease in provision, for doubtful debts. We talk about it at this point. Decrease in provision for doubtful debts, so that once we have these here giving us the income that we are supposed to have, we come and less allowable expense. Remember, we analyzed the whole concept of allowable expenses, and we mentioned that simply these are the whole heart. This is a heart of tax. The concepts of allowable, non-allowable, taxable, non-taxable. So considering our case here, Considering our case here. Considering our case, we have all these allowable expenses that we had. Number one, of course, we are looking at allowable expenses, such as maybe you have bad debts. Consider it here. Maybe you have, say, like increase in provision for doubtful debts. We have it at this point. consider maybe the aspect of capital allowances. You have it at this point. Say discounts allowed. You have it at this point. Consider your rent expenses. You have it here. Consider salaries and wages. You have it here. So our focus will be to look at all other expenses that we normally incur for the purpose of generating our business income, or simply, we are looking at expenses that we normally incur for our normal operation. And we listed a lot of these expenses here. We listed a whole batch of these expenses. Maybe you can consider foreign exchange losses. Foreign exchange losses. These are, of course, should have been realized. See, and my good students, consider all the expenses that Mwalimu shared with us. Consider all the expenses that Mwalimu shared with us, so which you're going to have them here. After that, the next important element will be, we have to, this should give us our total allowable expenses, so that as at the end of the day, this will give us what? Our business income. This will give us our business income. See? So for us to arrive at this is simply, of course, summation of all these elements. This is simply summation of all these elements, which will give us our B. Take this to be our A. Business income will be our C, which in this context, we have A minus B to give us our business income. Consider our other taxable incomes. And this is where we are going to consider, other than your normal business income, other than what you generate in your normal activities, what are these other incomes that you generate? Maybe you have some rental income somewhere. You consider your rental income. Maybe you have now what we talked about, aspect of non-qualifying interest. Remember, we mentioned that this will be aggregated. This will be aggregated other incomes and tax further. Non-qualifying dividends. Consider it at this point. And any other investment income that you might be having, which is taxable. Any other investment income that you might be having, which is taxable. See, so you consider all your incomes. And remember, at this point, the non-qualifying both dividends and interest, we are talking about gross. This is something that should be very important for us to be able to understand. We are about what? Gross. Okay? So that as at the end of the day, determining our total other incomes, we can comfortably come and say our total taxable income would be total taxable income would be, this is what we'll be having. So at this point, my good students, this is what our gross profit approach. This is our gross profit approach. This is our gross profit approach. Have it quickly, have it quickly. Mm-hmm. So once we have this concept, the next important question would be, when are we supposed to use this approach? When to use the approach? When to use this approach? So, my good students, the best time that you can use this approach would be a situation where the examiner is asking you, required given would be determine / compute the taxable income for the year ended XXX. Key element is determine / compute the taxable income. You'll get the difference when we'll be looking at, of course, you'll get the difference when we'll be looking at the other approach. So key element here is determine what? The taxable income. Determine or compute the taxable income. Taxable income, you can be told profit, taxable income / profit. Or loss for the year ended, given that case. So you'll get the difference when we'll be looking at, of course, the aspect of a reported profit approach. So once we have this, the next item would be, what about the second approach? What about the second approach? The second approach is a reported profit approach. The second approach is a reported profit approach. So the whole idea of a reported profit approach, my good students, is for us to understand that the accountant, financial accountant, has prepared, the financial accountant has prepared the books. So once this has been prepared, the next element that you're supposed to do, you as a now tax accountant, is to analyze what the financial accountant did. There are some expenses that we do recognize in accounts, which are not recognized in, of course, tax. There are those incomes which you do recognize in financial accounting, but you don't recognize them in tax. So these are the items that we are adjusting. These are the items that we are adjusting. These are the items that we are adjusting. So once we have this in mind, then of course the task would be very easy. How will we go about it? To go about it, this is what we need to have. The title will always be very important. The title will always be very, very important. MD Rasa Limited computation of adjusted taxable income. First, note something that is changing there. MD Rasa Limited computation of adjusted taxable income. Of adjusted taxable income. Of adjusted taxable income. So once we figure out the theory about of the adjusted taxable income, then start with what has been prepared by the financial accountant. There is this reported profit, or the net profit, that has been prepared by the financial accountant. There is that net profit or reported profit that has been prepared by the financial accountant. So we need to adjust with the following. There are expenses that were considered in financial accounting, but we don't recognize them in tax. So what are we going to do? We come and add back non-allowable expenses. Just add. These are expenses that were considered in financial accounts, but we don't recognize them in tax, such as depreciation. We don't recognize depreciation in tax. Come and consider it at that point. We have an item of, say, like general provision for doubtful debts. We have purchase of fixed assets. We have loss on disposal of fixed assets. Consider expenses that we've incurred as a result of our negligence, fines and penalties. Say like legal costs in relation to breach of contract. Maybe unrealized foreign exchange losses. unrealized foreign exchange losses. See? And any other form of non-allowable expense that we mentioned. I remember I gave you a clue where Mwalimu mentioned for you to consider that this is a non-allowable expense. Number one, look at these expenses that have been incurred and they are not relating to the business. Number two, we said anytime you're considering expense in relation to the purchase of fixed assets or expenses that are incurred as a result of the negligence of the business person or maybe the taxpayer. So all these expenses are what now we come and consolidate them as non-allowable expense. So have all, I give you a very long list. Mwalimu shared a very long list in relation to that. So that is what we need to consider here. All the items that we listed, if at all you come across such. So then this will give us the non-allowable expenses. After that, come and consider the incomes that were recognized by the financial accountant, but in tax, we don't recognize such. So we less non-taxable incomes. These are incomes that, yes, they have been recognized in financial accounting, but in tax, we don't recognize such incomes. Like what? Maybe gain on disposal of fixed assets. There is income that you earn from foreign investment, income from foreign investments, say like dividends and interest income that you earn from foreign investments. You can consider foreign exchange gain unrealized. You can consider, my good students, aspect of qualifying dividends and interest. Remember, we mentioned that these are what? Withholding tax is final. These are, on this case, withholding tax are final. So therefore, they're not supposed to be aggregated with other income. So if at all they were included, kindly come and consider the same. And any other non-taxable income that Mwalimu shared with us. So we have to consider it at that point. Come and consider capital allowances now. Come and consider capital allowances. We also deduct so that as at the end of the day, whatever that I'll be having here, these are what would give us what you're referring to now as the adjusted taxable income. We have adjusted whatever that was given for us to arrive at now what we're supposed to consider for tax purposes. See, where for us to arrive at that, we said, assuming this one is our A, this one is our B, this one is our C, and this one is our D. Therefore, we will have A plus B minus C minus D. See? When are we supposed to use this approach? When to use this approach? When to use this approach? So the when to use is where the examiner here has instructed us that, you know what? Where the examiner here has instructed us that whatever that you're supposed to do is to determine or compute the adjusted taxable income, and you're not given any further instruction. Determine / compute the adjusted taxable income for the year ended that, and you're not given any other further instruction. You're not given any other further instruction. You just asked to compute or determine the adjusted taxable income, and you're not given any further instruction. Then that is the best time you're supposed to use what? To use this approach. Best time to use that approach. These are the most important, this is the most important concept that you should be able to understand. Because all the questions more so under business income, from now henceforth, it will always be a matter of us knowing which approach to use. And all these items, allowable and unallowable, taxable and non-taxable, already we had looked at them. So making our work even much easier. Making our work even much easier. And I told you once you're through the basic concepts, it will be as if you're through the charts. Because all other things will just be going back on what we mentioned. We'll just be going back, referring back to what we said, referring back to what we did, and you're going to agree with Mwalimu that honestly, once you're through the basic concepts, then all other things for tax will just be a matter of repetition. Okay. Where if you have a question, kindly you ask.
Mwalimu.
Yes, please.
Yeah, good evening.
Good evening.
What I wanted to ask, like both approach are all examinable. The examiner can throw in any.
Sure. So it is upon you to know. Yes, please.
As per the question papers, so they can throw in any at any time.
Sure.
Okay.
You can be asked any. So that's why Mwalimu is saying that the best way to know which approach is you look at the required. If at all the good examiner is asking you to compute the adjusted taxable income and probably you're not given any further instruction, then the best approach would be what? The reported profit. When the good examiner is asking you to compute the taxable income or profit and you're not given any further instruction, then the best approach would be the gross profit approach. Are we on the same page, Dennis?
Yes, we are.
Great. So once we have that secret, Once you have that secret, then Mwalimu would guide us on another concept here, still relating to, of course, the basic concepts. And in this case, we want to look at the concept of the effects of understating or overstating, effects of understating or overstating inventories, purchases, and sales on the profit. If you overstate your sales, if you understate your sales or maybe inventories, what or how will it affect our profit? How will it affect our profits? These are what Mwalimu wants to guide us. Mm-hmm. So this is what we must always tend to have, of course, at the back of our mind. Once we have these items defined, many a times they might be overstated or understated as a result of various factors like VT, maybe aspects of the normal errors that will always tend to happen. So the whole idea would be then how will they affect our profit? And if at all they are affecting our profit, how can we correct the same? These are what we'll be looking at here. So then at this point, we consider the following. We can consider our items here, where the first item probably we can start with what if we overstate. This is overstating. Overstatement of opening inventories. We want to look at the effect on the profit. Effect on the profit. Effect on the profit. And how to correct. So we have these items: overstatement of opening inventory, understatement of opening inventory, we have overstatement of purchases, understatement of purchases, overstatement of our closing inventory. Understatement of closing inventories. Overstatement of sales. Understatement of sales. What we need to have? So clear this so that you can look at it together. So in the event that we overstate our profit, or rather our opening inventory, what will be the effect on our profit? Our profit will be what? Understated. It will lead to understatement of profit. It will lead to understatement of our profit. It will lead to understatement of our profit. So how are we supposed to correct this? We need to add back the overstatement. What will be the impact in understating our opening inventory? It will lead to overstatement of what? Our profit. So to correct that, we need to less the understatement value. We are going to prove all this. The same effect would be on the purchases. The same effect will 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 be on the purchases. It will shift on closing inventory. Overstatement will lead to overstatement of profit. Understatement will lead to understatement of our profit. The same effect on our sales. The same effect on our sales. Same effect on our sales. And I want us to prove it now. Have that fast. Mhm. Great. Believe that you're done, right? So let's look at this effect practically. Let us look at these practically. Take, for example, this case. We have the actual. For actual, maybe you have sales. Sales, maybe you have, say, like 5 million. Yeah. And the cost of sales. Cost of sales, this will give us opening inventory. Say like 2 million. Purchases. Purchases, you can take, say, like 2.5. So then closing inventory. Can take, say, like 1.5. So that at the end of the day, this will be our cost of sales. And finally, our gross profit here. Okay. Mm-hmm. Actual data. Mm-hmm. Consider the effects. What would be the effect of overstating our opening inventory. Overstatement of our opening inventory. See the effects, my good students. Assuming this opening inventory is overstated by 2.5, or rather by 500,000. So it was supposed to be 2 million, but you overstate it with 2.5. You see the impact. It will understate our profit. The profit should have been 2 million, but if we have overstated our inventory opening, you see the impact, 1.5. The same impact, look at it, what if you understate? Understatement. What if you understate? So this is understatement. Understatement of opening inventory. Look at this effect. So instead of us having the original of 1 or rather 2 million, we have 1.5. See the effect. We overstate our profit. Exactly what Molimu was giving us here. See the effect. Overstatement of opening inventory, it will lead to understatement of profit. If you understate, it will lead to overstatement of profit. And these are what we are looking at this point. See. The same concept will happen with purchases. The same concept will happen with purchases. Overstatement of purchases. If we overstate our purchases, instead of 2.5, we have, say, like 3 million. See the impact. Our profit will be understated. The same effect if this is done by understating our purchases. See the effect. If you understate your purchases, instead of 2.5, you have, say, like 1.5. See the impact. These can clearly prove whatever that you've written. See? These will clearly give us a proof of whatever that we've written there. Very important to understand, very important to note. Very important to note. The same test you can do with inventory closing. Closing inventory. The same test you can do with closing and closing inventory. Compared to the original. These are original sets. This is our original set. Look at the effect. The moment you overstate your closing inventory, instead of 1.5, maybe we have 2 million. See the effect? You'll overstate your profit compared to what it should have been. The moment you understate, see the effect? Understate, opening, it will understate your profit. The effect, that will be the case. Overstate, it will overstate your profit. That will be the effect. And similar concept you can look at when you're dealing with what? Sales. So it will always be upon us. It will always be upon us to consider anytime we are focusing on these items, you look at what you're given. So after you've considered what you're given, majorly it will come as a result whereby the good examiner will either tell you directly that this item has been overstated, or you will be given the aspect of maybe the sales item was inclusive of VAT. So it is upon us to look at the scenario that we are handling and, of course, effect to the changes as per what you're supposed to do. I need a question there. If at all there is any question where you feel like Mwalimu should explain again. This information is very, very important. And you're going to see it affecting us in most of the things that we'll be handling. So if at all there's a question, then there's no any other better time to ask than now. Okay, then assuming you don't have any question on that, this should take us to the next important segment. We said basic concepts will always entail allowable expenses, non-allowable, non-allowable, taxable, non-taxable, taxation of other sources of income or simply investment income, which is basically dividends and interest. The other segment is for us to understand the approaches of determining our taxable income. Then the fourth main item would be for us to understand the capital allowances. So before we proceed to capital allowance, Mwalimu is asking, is there any question? Great. Now we can proceed to capital allowances. Capital allowances. So I'll give a very simple concept in relation to this so that you can be able to understand the root of capital allowance. My good students, you purchased an asset. Okay. After purchasing this asset, here in this context, like for taxman will always be looking at it like he wants to encourage you to continue investing. Yeah? Because at this point, the taxman has advised us that at no any given point are we supposed to deduct total fixed asset as part of allowable deduction. So in compensation for that, the taxman would be like, look, you invest in capital items. After you invested in these capital items, let us sit down and agree of whatever that I have invested, take a portion of that cost, then deduct it from your income so that it will help you to reduce your taxable income. See? A very, of course, a very simple concept to literally explain that. See? So we are looking at it in this context. We're saying that today, assuming Dennis has decided that, you know what, I am investing. So Dennis Limited. Dennis Limited has decided to purchase, say, like a machinery. Dennis Limited has decided to purchase, say, like a machinery. So this machinery that I'll purchase this machine at, say, like 5 million. Remember, we said that this cost, you see, this is a cost. This cost of this machine, the taxman has told you not to deduct. And that's why we said this is non-allowable expense, purchase of fixed asset. But what the taxman will do, will come and tell Dennis, Dennis, you know what? We want you to continue investing so that out of whatever that you've incurred, don't take the whole cost to deduct from your income, but kindly take a portion of, say, 25%. Each year, be taking 25%, which will be deducting from your income. So you take 25% of that. So instead of me deducting the whole 5 million, I'll only deduct 1250. So this 1250 is what you are looking at it as what? A capital deduction or capital allowance. So that's why we've said capital allowance will be taken as allowable expense. You see, we took capital allowance here as allowable expense because now the taxman has permitted me, the taxman has permitted us to deduct. The taxman has now permitted us to deduct these expenses, these expense on our income. So that whatever that if at all I was supposed to be taxed 2 million, I will not be taxed 2 million, but be different. See, the whole idea of capital deduction. The whole idea of capital deduction. This is the simple concept that you can be able to understand when you're looking at capital allowance, and the reason why we normally tend to say capital allowance as allowable expense. A simple concept as that. So then, once we have this concept, Mwalimu will now introduce us to this concept. I've given you the basics. Now we can mention something in relation to this. We say that Capital allowances refers capital allowances refers to the tax relief, refers to form of 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 tax relief that allows businesses that allow, of course, business to deduct a portion of the cost, to deduct a portion of the cost, to deduct a portion of the cost of certain capital assets. See, of certain capital assets, just as we are looking at the example of that Dennis Limited. See, e.g., the assets that you can consider, we can mention several. Talk about maybe you can list, say, like e.g., you can talk about machineries and equipments. Machineries and equipments. Talk about buildings. What you can mention about buildings. etc, etc. All these items talk about machineries and equipments, buildings, and maybe motor vehicles, say, portion of the cost of these items, etc, etc. From what we are deducting this, a portion of the cost of certain capital assets from what? From our income. See, from their taxable profits. From their taxable profits. From their taxable profits. See? From their taxable profits. A simple concept as that, whereby you need to understand that, kumbe this capital allowance, anytime you're talking about the same, all that we normally tend to look at is always a portion of the cost of the item that you're considering. See? So it is nothing complicated, my dear students. It is as simple as this. It is as simple as this. It is as simple as this. So once we have this right, this should take us to now the categories or types of capital allowances that you're going to look at. So about types of capital allowances, not unless there's one who has not understood the concept of capital allowance. This is the best time to ask, because the concept is as simple as that. The concept is as simple as how Mwalimu has tried as much as possible to simplify it, so that you should be able to understand that, these items are not always tricky. They're very simple. They're not tricky, so long as you are able to understand the whole concept behind it. So, number one, we normally talk about investment deductions. So we have this general. We have number one, investments. Investments deductions. Or investment deductions. Commonly known as ID. Number two, industrial building deductions. IBD. And Mwalimu normally refers to this as what? Mr. Date. I'll give you the reason why we normally refer to it as Mr. Date. Industrial. Sorry, right here. This is industrial, yeah. Industrial building deductions. And in this case, Mwalimu is referring to it as Mr. Date. And I'm going to give you the reason why I normally refer to it as Mr. Date. Number three, we have wear and tear allowances. Number four, for now combined shipping investment deductions. Mining allowances. About, of course, farm work deductions. Farm work deductions. So these are the major, or rather types of capital allowance, but the major ones actually, and what you're going to concentrate majorly on are the first three. Investment, IBD, wear and tear allowance. These are what you're going to concentrate on majorly. These are what you're going to concentrate on. I need a question. I need a question.
Morning, will you share this notes?
Sure. I'm going to share this document immediately after this.
Thank you.
Great. So then, guys, we start our journey tomorrow from this place. I know tomorrow we clear almost up to, tomorrow we might clear up to WTA. Because once you're good with investment deductions, these are where actually we might clear, even if I know we clear the first two, but WTA, even if we're not clear, but we can reach up to the 3/4 part of it. Because trust you me, once you're done with capital allowance and you're done with employment income, it's as if you are through with the aspect of tax, because most of the things we just be repeating, going back to allowable and unallowable, taxable and taxable, looking at the best format to use. See, so just be repeating. So the most important thing is we must start these basic concepts. It will help us a lot. It will help us a lot. Yeah, so to this point, if at all you don't have any question, you guys have a very good night, and we hook up tomorrow. See you tomorrow. Bye-bye.